Thank you for joining us. The afternoon is still long. You have plenty of nice panel to come. This one, for those who were this morning, will have a special taste for me because I'm not on stage anymore this afternoon. So I'm very happy to welcome for that last interview today with me my friend Renaud Laplanche. I'm sure most of you know and remember this godfather of fintech. What a tremendous journey. For those of you who are working in the fintech industry, so I assume like what, 100%? Everybody remember when we saw this French guy going in the States and doing that big venture, so let's discuss about that. Can you tell us more, just to begin, about this astonishing story of Lending Club, which was like, what, 14 years ago?
Yeah, about that. So the idea of Lending Club came to me in my living room, actually, when I was opening the mail, and I realized I was looking at a credit card statement and reading it, which is not something I usually do, but I read the credit card statement and realized that if I was going to carry over the balance to the next month, I'd be paying 18% interest rate, which I thought was really a high rate. And then the next piece of mail that I opened was a savings account statement where I was earning 0.5% on my high-yield savings account. And just the spread between the two rates was striking. And so I just started to do some work just out of curiosity to try to understand, hey, where's the money going? Why is it that if you put your money at the bank, you earn 0.5%, and if you borrow money from the bank on a credit card, you pay 18%.
Good business.
Yeah, no, it's a good business, but it's actually not all profit, obviously. Part of the spread is explained by the very high cost of operations from the banks, and just that process of taking short-term deposits and turning them into longer-term loans, and all the branches and employees and compliance.
And the cost of risk.
And the risk that goes into that process. So the basic idea of Lending Club was, okay, let's create an online marketplace that essentially streamlines the entire process with borrowers on one side, lenders on the other side, all individuals, and have them lend money to each other.
So that was the pitch. And then what happened?
So it worked out quite well. Initially, it was really hard because it was entirely new business.
Created just before the crisis.
Yes, yeah, we launched in 2007.
Good timing.
Perfect timing. And so the idea of lending money to people, to strangers on the internet, wasn't a very attractive idea from a risk standpoint. And then immediately after that came 2008 with all the stories in the newspapers about people defaulting in their mortgage. So that made the lending side of the marketplace pretty slow to start. And then over time, we built up the track record. We showed the public and the market that we could underwrite and service loans properly and deliver a nice return. And so it started to take off. So by 2014, we were doing 400 million in revenue. We were sort of cash flow positive, profitable, 20% EBITDA. And we thought that's the right time to go public, which we did.
So 2014, New York Stock Exchange.
That's right, yeah. Ringing the bell, fantastic.
Is it still a big memory?
Yeah, that's an amazing memory. And we did, I don't know if you remember some of the visuals, but we basically turned the facade of the New York Stock Exchange on Wall Street completely red, which was the sort of Lending Club color, maybe an ominous sign in hindsight.
For an entrepreneur, it must be like a very big day.
Yeah, no, it was amazing. Yeah, it was a really big party.
So we are already arrived at the big top of Lending Club history for you, but just before going to the next steps, let's go back a few years back. So you had a very good idea to do a credit business 1 year before the credit big crunch. So, of course, no one can know that before, but did you have an idea in 2008 to stop? I mean, because many entrepreneurs here perhaps will have the same issue, crisis can come anytime. So when the crisis arrived, did you say, okay, that was a bad timing, I stop, or on the opposite, you just try to find all the good things to continue? I mean, what happened during 2 years?
Yeah, so it's interesting. I think we sort of turned lending into a marketplace, but it's a two-sided marketplace, the borrowing side and the lending side. So certainly 2008 made the lending side, the capital side, harder, It also, in a way, validated the need for the marketplace, and the borrowing side was doing great because it was
no other banks were
there
giving
was
money.
no other game in town. So a lot of people coming to us, and that helped us really build a lot of data and better understand the behavior of the borrowers and the type of products they would like. So we used all that as a lab to sort of continue to evolve the product and then find the sort of the equilibrium between supply and demand, and thought, okay, if we're really thinking of it as a marketplace and we have more borrowers than lenders, it means the rates aren't high enough. And then you start acting almost like a Federal Reserve, where you have supply, monetary supply and demand, and you understand that moving interest rates actually sort of maintains the equilibrium.
Should I call you governor? Or so, if I understand well, 2006 ignition, 2008-10 big crisis, but happens to be quite good for you. 2014 the big dream from an entrepreneur, and then the entrepreneur clash. When was that?
Yeah, 2016 was when I left Lending Club, like second quarter 2016.
I assume you can't elaborate too much, but what happened?
Yeah, so we had a pretty big compliance issue, like it also often happens in financial services. It's a heavily regulated industry. And I think a pretty severe disagreement, both internally and with the board, on how to solve the issue, who should be accountable for it, and more importantly, how to move forward. And that disagreement couldn't be resolved, so I left the company.
So you left what we could call your baby. Did you add a baby blues after that?
Yes, a bit of a baby blues, but so the way I coped with it was sort of immediately starting something new.
Directly?
Directly, within days, literally.
Literally?
Yeah.
Perhaps a way to cope with these blues. Yeah?
Well, yeah, no, it was my way of managing the issue. I mean, what was wonderful about the process, it was very painful and disappointing in many ways. But what was really sort of quite amazing was the amount of support I got from the team. So when I left, a lot of people resigned in protest. And so that I had like really a team of people who like pushed me to start something new, and so I had like 20 people I could hire overnight and get going, and some of the like best people from Lending Club who all wanted to do something together. And then the investors, so for a lot of people who backed me up at Lending Club, all the early equity investors said, okay, we'd like you to start again, and we're behind you, and so they funded the new venture.
Yeah, we'll come back to Upgrade in a few minutes. Before to go to this new big thing, some key takeaways of what I call here for the game, the godfather of fintech. So first, on the Lending Club experience, some key takeaways for the entrepreneurs there you could share with us.
Yeah, so I mean, plenty, but I think at the end of the day, a lot of like successes and failures get back to people, right? And how we anticipate issues and how we solve it as a team. And I think one of the things I learned in that process was how important finding the right balance between the fin and the tech part of fintech is so important. It was important in the success of Lending Club, but even more important and more critical to get it right when you have a crisis, and that's going to dictate how people react to the crisis. And very often in fintech startups, you have this mix of like engineers, online marketing folks, product folks who are like very good at consumer products and growth, and usually former bankers in the finance and control functions that are also pretty good at risk management and compliance. I think what's key is like finding that balance, but also make them work well together. And make sure there's no
like no Chinese wall.
Yeah, no Chinese wall, and really mutual respect and understanding of like how important each side really is to success, and not have one side think that they're doing all the work and the others are idiots, because that's a recipe for
By
success.
listening you, I heard that it happened.
It did, unfortunately.
And another takeaway of that long story?
Yeah, well, I think just like the going public part. I think in hindsight, we went public way too early in the life of the company and the level of maturity of the company. And when you have the bankers and everything, I think we all tend to focus too much on the IPO itself and not enough on what happens next after the IPO.
Why did you decide to go to the IPO? Because your investors said, we want the money now, or because you think it was just, I mean, for you as an entrepreneur, something to check on your list?
Yeah.
Or, I mean,
probably a bit of all that. There's some ego and some all that, but also I think there's a real sort of branding benefit, right? It's a big PR event. It makes the company more visible. It projects a financial stability, which is good when you work with partners, especially when you partner with banks. I mean, they like the sort of the transparency and the financial stability of a public company partner. So I think there are real benefits of going public for sure. But again, I think we all focus too much on the wedding and not enough on the marriage.
So you had real post-wedding issues?
Yeah, I mean, not necessarily issues, but just not enough planning going into it. I mean, we spent way too much time thinking about what the stock price offering was going to be and the offering documents and drafting these documents, and clearly not enough time thinking of, okay, what it means to operate as a public company.
Oh, so I assume the day after would have been complex.
Right.
Okay, I see the time is running. So I want we speak a bit about upgrades. So just before, one question. Global view on the fintech ecosystem?
It's fascinating. I think we're still in the very early days. I think when we look at the evolution, so from the last decade to the one we're in, I think with Lending Club and others, we sort of pioneered some of these like early days of fintech. I think we are all focusing on getting one product right? And so we started with lending, some started with payments, and it was very sort of monoline approach. I think what you're seeing now is a lot of companies sort of launching multiple products and really sort of recreating, sort of rebundling these banking services and recreating a digital bank. But the way each company is going at it is very different, right? So we have Robinhood starting with stock trading, you have Wealthfront and Betterment in the US starting with robo-advisors. You have a lot of companies like sort of N26, Monzo, Revolut starting with sort of payments, sort of debit cards and deposit products, upgrades starting with credit. So we're all starting from a different angle and all converging and adding multiple products and creating this experience. I think the best example of that is either Nubank in Brazil or Tinkoff in Russia. I think
both of them were on this stage. The CEO of Tinkoff and Nubank was there last year.
I know, you got the right people. Now I think Tinkoff is an amazing success, and they're even going one step beyond. So they have all the banking products, all the great banking experience. They're now going into what they call lifestyle banking. It's almost like going into the super app world and then becoming a competitor to sort of WeChat. What Tencent did with WeChat was creating this one app that has social media, e-commerce, payments, and you live in the app.
Thank you very much. So now, yesterday I said on stage I didn't see Revolut coming when I invite them first. So I wouldn't like in 5 years to say I didn't see Upgrade coming. So please tell me more about this new idea you had a few years back. What is it and what are you doing now?
Right. Yeah, so I mean, we try to take it one step further and continue in our quest to deliver sort of great, affordable, responsible credit products, but really build the next stage of the Orca chip, which is really going into sort of overall sort of mobile banking experience, but banking grounded into credit. Credit revenue is like 70% of banks' revenue. It's often the number one reason why consumers seek a banking relationship. And so if you're going to build a neobank, a challenger bank, or any bank for that matter, you'd better have good credit products because your customers are going to want it. And creating good, affordable, responsible credit products is really hard. It takes time. It takes a lot of compliance, risk management, credit, the all underwriting, whether you use machine learning algorithms or more So traditional underwriting is grounded into data and accumulating that data that really makes you smarter and tells you how to underwrite and service good customers is really hard. So it takes some time, and I think so we started from credit products with loans and cards. Is it okay if I show the upgrade
you
card?
can,
Okay,
yeah.
all right.
He wants to be the sales guy. You know,
can't resist.
at lunchtime, the time you do it, some people were surprised, and my minister also, that we didn't add a French winner at the startup pitch. So for those of you who were not there, I just said, see the difference between he's French, but he's not anymore French. A French pitching a company, an American. He wants to do advertisement directly.
I just want to show the product. All right, so that's the upgrade card. I think what's the big deal about it is, first, it's green. It's the greenest card you can ever have. Second, more importantly, it's really, I think, the only credit card that's good for you, right? I mean, credit cards tend to lead consumers into a revolving debt cycle trap because it's a very high interest rate, a lot of fees, but more importantly, the balance doesn't really amortize very much down. So if you make the monthly minimum payment, it's going to take you 25 years to pay off the balance, and you're going to end up paying 3 times what you initially spent. What the upgrade card does is really sort of giving you a line of credit, but at the end of the month, the balance turns into an installment plan that you can pay off over 1, 2, or 3 years at a fixed rate, fixed monthly payment. So it really it creates a forced discipline for consumers to pay down their balance every month and really get out of debt and have a clear finish line where we can say, okay, great, I used credit, but now I'm out.
What's the size of your market?
I'm sorry?
What's the size of the market you address?
It's growing so fast and so quickly. When I started Lending Club, there was about $700 billion in credit card receivables. When I left, it was 850. Now there's 1.08 trillion. So the size of the problem I'm trying to solve has increased by 400 billion. So I'm not very good at solving problems.
And who are your competitors right now when you try to sell your green card to everybody?
I think the main competitors are the main card issuers in the US, right? So it's CD, Discover, Capital One, Wells Fargo, Bank of America.
No one is afraid of you, you just go.
No, I mean, it's such a big market, but I think the way we compete is by delivering sensible credit products that are responsible, that are the right thing to do. We create more discipline in the way people manage their credit, and we offer lower interest rate. We have a 6.5% starting rate, and try to deliver a great experience. Net Promoter Score is 79. If you compare that with most large banks in the US are in a single digit or negative. I think we can compete.
So I hope when you come back in a few years for another project, you will explain us how Upgrade is now the biggest in the US. Thank you very much. You can applaud Godfather of FinTech.
Thank you.
Thank you, Renaud. Thank you.